You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
All right, everybody. I'm excited. This is something fun. This is something new. This is the beginning of, dare I say it, a new era here on the Options Insider Radio Network. Welcome to the inaugural Options Insider Pro Q&A session. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the old network upon which so many of you are used to binging and mainlining for, over 14 years now. So a lot of great content for you there in the archives. But as I mentioned, this is something new. This is the beginning, the kickoff of what we announced for the first time only a week ago. It seems like it's been a lifetime ago, but it's only been about a week since we announced the launch of Options Insider Plus and Options Insider Pro. And part of the Options Insider Pro is going to be fun, interesting, exclusive new content for our Options Insider Pro members. I'm glad to see so many of you have already jumped on and taken the plunge and joined us over there on Options Insider Pro. We love all of you out there also on the plus side. So we thought this is normally, going forward, this is going to be exclusive for those folks who have taken that plunge and embarked on this journey with us here on the Options Insider Pro side of the fence. But we've thought for this week only to give you guys a sense of what we're up to over here. We're going to make it available to everyone here on the network. You're going to get it on the podcast. You're going to get it live right now. In fact, I see you folks piling in right now. Going forward, these live sessions are not going to be available for everyone outside of the members as well. So just something to bear in mind. If you like this, if you enjoy this kind of content, you like picking people's brains, leading experts from the world of options and derivatives, and we're going to run the gamut, listeners. It's going to be exciting, all sorts of fun stuff. And of course, if you're a member, you have a guest, you like to pick their brain, hit us up, let us know. We'd love to hear from you folks. We'll see if we can make it happen for you guys out there. So this week, you're going to get a double dose of course, our first ever Pro Q&A session. That's today. And then Friday, you're going to get the first dose of the inaugural Options Oddities. Yes, the return of the program you folks have loved and asked about ever since it went on hiatus. I forgot how many years ago now, at least 3. So you guys get both of those. Don't worry if you're a pro member right now. We're adjusting you to get an extra week. So you're not paying for a week that people are getting it for free. Don't worry. We take care of all of our people here. We want to give everyone a taste of what is cooking over here. And a lot is cooking. And we thought, given how many questions you have bombarded this guest with over his appearances now on the network, we thought who better than to kick off our inaugural Q&A sessions here on the Pro Network than none other than the Oracle of New Hampshire himself, a.k.a. the keeper of that magical backtesting machine, a.k.a. the keeper of all the earnings volatility, none other than Mr. Matt Amberson, the founder over there at Orats, a.k.a. Options Research and Technology Services, a.k.a. the guy who danced in that ZZ Top video. Mr. Matt, welcome to the inaugural Pro Q&A session. Are you as excited as I am, sir?
I am pumped. I'm excited. I'm honored to be here. This is exciting. We've had such great questions. We always have trouble getting to all the questions, so it's going to be great that we could interact and get to all the awesome questions that your clients, pros, all the listeners that come back week after week I'm excited, Mark. Let's go.
All right, let's do it then. You heard the man. He is ready. A lot of you have already taken advantage of the opportunity. You've already hit us up. You've sent in a bunch of questions already. So we already have a ton. These sessions are probably going to go for about an hour or until your questions are exhausted, whichever comes first. I'm not going to keep Matt here for 10 hours, even though you probably could answer all of your questions here. But if you guys are listening live, if you have questions you want to chime in, hit us up, let us know. Going forward, again, this is going to be only for the pro members. So if you're listening live, take advantage now. Get those questions at us. Matt, I know it's intimidating to be the first one here in the hot seat, so we'll ease you in. How about that? We'll make it fun to start off for you, so you're not sweating over there in the land of New Hampshire. This first one comes from Tony. He just wants to know, very simply, how did you get in the sharp-dressed man video?
Well, this is the most intimidating question, Mark.
Uh-oh. We started off with the big one. I'm sorry.
I was talking to some of our guys at work at ORS weren't even born when that sharp dress video came out. So I had to explain that it was ZZ Top, and they still didn't know what I was talking about. And I said, these rock and roll guitarists with long beards. It was one of the top videos back then in the 80s, I believe. And, we used to play beach volleyball, and there was guys in Hollywood that were beach volleyball players that said, hey, we need some extras. You guys are a fun-loving group. Let's come on out to downtown LA, which is about, 45 minutes away with good traffic. And all night we stayed up and did in a abandoned bank. And of course, we met ZZ Top and danced all night. And, a lot of it ended up on the cutting room floor. But, you guys, your crack staff caught the picture of me on there. And then, what, your crack staff needs to get to cite out the movie, because I have a few choice appearances there. So that's the next thing, Mark.
Uh-oh. You have a film now as well. So now our listeners can bombard you with questions. You have to check out your IMDb. Multiple appearances there for Matt on the IMDb. So we'll have to check that out, listeners. So there you go. I knew that one was coming. I knew this next one was coming to Matt. This one just happens to come from AJK886. Sounds like a droid in a sci-fi movie or something. They say, is there a right answer? When I'm trading earnings, should I lean long or short options? Matt, this is kind of the perennial question. You and I have chewed over this for ages, ever since we first started really analyzing the earnings vol data over there at ORATS. So you've been crunching the numbers. Dare I say it, you are the keeper of the earnings volatility data. What do you have to say for AJ and everyone else out there? AJK and everyone else out there who has a question like this going into earnings season? Is there a way they should lean?
Well, if you would have asked me this 1 year ago, I would have said it's probably better to lean long, because it's about a coin flip, and you don't lose as much, and might as well. It was about what was it, 40% win rate, and so, but there was a break even approximately for being long options. As we know, that has changed this last year. It's now brutally underwater. So I would say some type of a way out of the money, and I'd just do one side. I wouldn't do both sides. Just try to get lucky on one side. That's the way I would play it. Out of the money, put spread for a credit, or out of the money call spread for a credit. Some of the successful people that trade earnings, do time spread, so you could figure that out, how we show how the volatility would come in, so you could model that out. So those are the types of things I would think about around earnings, Mark.
And you're right that the last year does kind of gum up the works, because the last year and change since the pandemic has been just a bit of an aberrant period. Let's just put it mildly. And again, if you're not sure what all this is referring to, go check out Matt and his team have put out those earnings move results, and earnings season reports. You can get them all over there at the optionsinsider.com. Click on the options news and articles tab, and you could see all that good stuff. You can see what we're talking about, how no matter what seems to happen in a lot of these names over the course of the last year and change, doesn't really result in a lot of activity, and certainly a lot of volatility as a result. So that's been a little bit of an aberration, to say the least. All right, we probably talk earnings probably for the rest of the hour, Matt, but we've got questions here coming in hot and heavy. This one comes in from our regular listener, pro member over there, my boy Luigi. He wants to know, what is the best way to use skew to your advantage? I know to look for the IV difference with calls and puts, but not sure I understand what is meant when they say a higher implied volatility represents risk in that direction. So Mr. Matzer, we had to say for Luigi, wants to know what is the best way he can use skew to his advantage. I know this is an area you've been looking a lot at of late, sir.
Yeah. So the way to think about it, for 4 options, just in general, implied volatility is the estimate of how much the stock is going to move. So if you buy implied volatility and the stock moves a lot more and it goes outside of your range or your hedging and such, that's usually a good thing. Now, skew is just the next derivative underneath that. And skew asks you to look at the distribution of returns. So, now, or there at least used to be, a skew to the downside, meaning the puts were trading at a higher implied volatility than the out-of-the-money calls. And so if that distribution did not hold, you can see profit in a hedged position, having long calls and short puts and then hedging. It's a difficult position for retail to do, but that's one of the ways to think about it. So what's happened, now since what I've called many have called the Robin Hood effect, is now the skew has moved from puts to about even, and maybe even some of the out of the money calls are even higher than the out of the money puts. This is generally not in the indexes, but in some of the single stocks, especially the meme type stocks. And so again, if you have a stock that you think will move with an equal probability to the downside as the upside, and usually what happens in a market correction, you go down in an elevator and up an escalator, meaning you go up more slowly than you do going down, then having a skewed position where you might be short skew, where you might do a call spread, where you buy a call, sell a more out of the money call. That type of position may work better than other positions, given that increased call skew that we're seeing, and maybe not a commensurate change in the distribution to that side. And that's definitely what we're seeing in some of these stocks. The way out of the money calls are just trading at astronomical volatilities. We'll talk about it a little bit later, I think, about the selling the way out of the money calls. But suffice to say that there are many options out there that are trading way above what a skew and a historical distribution might suggest, Mark.
Yeah, I don't think this is our last question here on skew as well. I'm sure we'll have a bunch of these. I know this has been a hot topic of research for you of late, of skew, the Robin Hood effect, the meme stocks, call it what you will. Kind of hard to ignore it out there these days. All right. Next up, we got our first live one coming in. This comes from Big Mon. He wants to know, can you give an example of using stock to hedge delta? All right. Interesting question. I guess he wants an explanation of delta neutral type trading. Easy for me to say, delta neutral type trading. And perhaps if you have an example, have at it.
Yeah, but this is actually a seemingly simple question, but it has a lot of layers. As market makers, we used to have to hedge our deltas, but I'll take the question on its simplest form, and then we'll get into it a little bit more. So, if you have let's just say a hedged position like a long straddle, there's no stock requirement. It's a long put with a negative delta, let's just say negative 50, and a call with a positive 50. So if you add those together, there's no excess delta. Now, if the stock moves, then the call, let's say it goes up, the call will have a higher delta and the put will have a lower delta. That net delta might be, a net positive 20. So then you would need to sell 20 shares of stock to be delta hedged, so to speak. So now what we used to call it is hedge your happiness. If it goes up or if it goes down, you're equally happy. So think about it that way. Now, there are a lot of confounding factors. There's gamma. So now when we're above the stock, there is more gamma now down towards the strike than if it were continuing to go up. There are also sometimes when you have very small priced options, the tendency to have higher volatilities in those small striked options might create a higher delta. So the rule is if there's a higher volatility and there's an out of the money option, you have more delta exposure. So sometimes those extraordinarily high implied volatility small options will command a higher delta in the Black-Scholes formula. However, you would be advised perhaps to look at actuality rather than implied volatility. And it may be that the real distribution is less than that, and thus the implied volatility should be less, and thus the delta held should be less. So one of the difficult things about delta hedging is actually knowing the right delta. It's not as easy as just plugging in the formula that you'll see on the screen by a long shot. And a lot of trading firms, like I used to back traders on the floor. I used to have a market making operation on the floor of the SIBO, and that we would work on simulating deltas because volatilities would change, stocks would move, and so there's a lot that goes into that. So again, these are awesome questions, and we could go on forever, but I want to get to as many as possible. But I think that covers it for stock hedging with deltas.
I wasn't expecting a question on delta neutral. That's why I like our audience. They're always throwing us curveballs out there. Delta hedging, again, as Matt mentioned, this is not something that really is that viable for a lot of the retail out there. It requires a significant amount of capital and margin relief and everything else to do effectively. We were talking about this recently on our Options Bootcamp show with Dan about gamma scalping, which is kind of another side of doing this. And it's difficult for retail, but it's interesting to understand and to know out here. Speaking of retail out here, the next one comes from Chase Bennett. I do believe he was listening to one of our other shows, Matt. He listened to our Options Bootcamp show. We were talking recently about closing covered calls, and we mentioned, I believe it was Dan talking about how his system, he likes to close your covered call when the underlying moves through the strike. And we have Chase, he couldn't wait till Options Bootcamp, which is tomorrow. He has to ask his question now. He says, hey guys, love the show. On a recent episode about rolling covered calls, you guys mentioned rolling when the underlying goes through the strike price. I will likely have this happen soon, but I still have 50 days or so until expiration. Can I wait a bit? I know you typically wait to answer on the podcast, but my underlying just went through the strike. Oh, sounds like it moved even as he was writing the question. Can I wait till closer to expiration, or should I go ahead and roll? I would really appreciate your thoughts. So a couple of things there, Matt. Maybe first off, we've talked before about your optimal covered call structure. If you want to hear that, listeners, go check out the most recent episode of The Advisor's Option. Maybe a corollary to that, if you have thoughts on when do you like to close/roll a covered call? Is it when the underlying breaks through the strike, or is there some other criteria you use? And then B, to this latter portion of this question, Chase is worried because we were talking about rolling a covered call when it goes through the strike, but he's got a longer term covered call. He says 50 days left to go. Should he be rolling it now, or can he sit for a little bit?
So it's a difficult question, and a lot of it is determined by how you feel about your stock. But in a lot of our tests, even out of the money calls, just holding it to expiration has been the optimal strategy. So if you look on our blog, the ORAT's blog, and I'm not sure if you guys picked it up, but we tested almost every type of exit strategy, and usually it's just holding it to expiration. It back tests the best. So whether that's because right now Chase has options that are kind of near the money, but the stock has gone up. So is it more likely to go down? Potentially. So for whatever reason, it tends to back test best just to sell your calls. Generally leave them alone. But I would suggest looking at the study that we did, over 3 million back tests, and you can see some of the things that we found out, Mark.
So you prefer the set it and forget it approach to covered calls then, no rolling?
Yeah, I like to hold off. It's somewhat counterintuitive, but again, I look at testing rather than what I would think intuitively, Mark.
Yeah, because I know a lot of our audience, they tend to lean towards the more active side of the fence. So when it goes through their strike, they want to roll. And it sounds like maybe his outlook on this underlying has changed. Maybe let us know some more details, Chase. We can help you out a little bit more. What underlying, why you chose to go as far out. That's one of the reasons why I tend not to like the longer term covered calls for reasons like this. Doesn't give you as much flexibility. Shorter term, you can kind of take it as Matt does, set it and forget it, particularly in the weekly, because it's only a week. Unless it's a game or an AMC, it's probably not going to blow up in your face too much. And you can always reset, reanalyze what strikes you want to do and do it again the next week or perhaps even the next month. When you're going out 2, 3, 4 months, a quarter, whatever, things get a little bit more, shall we say, fluid out there. So yeah, it's interesting. I encourage you to check out that study. Maybe we'll have to retweet it or put it on the site as well so you can check it out. But the covered call analysis. Oh, Matt, you're not done. Sounds like you have more on the covered call side, sir.
Yeah, as a matter of fact, that's exactly right, Mark. What we found was the longer terms didn't work as well. And so if my recollection is correct, it was a 30-day, maybe a 15 delta. So that's pretty far out. And you might think, well, there's not that much premium there. But, you don't really think about the premium. You think about the premium capture. So you're going to capture a lot of that premium. Whereas if you sell something closer, it might be more premium, but you don't have a high of a probability of capturing it. So those are the things that I would look at, especially in today's environment. If you have stock, there are some options that are so far out of the money, you should be selling stock. Even if it's something that you don't normally do. I've been looking at these far out of the monies, and man, if I own stock for sure, I'd be selling something against it, because if it went to there, you would probably sell it, and probably not going to go there, Mark.
Going into the dark side of selling the wings. Maybe we'll get to that. I'm sure you probably have a question about that somewhere here too. But yeah, fascinating stuff. As I do recall, Matt, and all your back tests you've done in the past too when it comes to covered call, it still seems like the lion's share of the outperformance, the bang for your buck, comes on the appreciation side. So another reason why probably these smaller delta type calls, particularly in this environment, do pretty well, Matt.
Yeah, and also, we are testing in a bullish environment, so you have to keep that in mind. That's not going to continue, or it may not continue. So you just have to keep in mind, the back testing environment. But yeah, in our tests, now we have a lot of, from 2007 to now, there's been quite a few environments. So it's really shown, out of the money, not too long. And I'm going to pull it up right now because I think it was avoiding earnings as well. But I'll get it up here, Mark. And you know what I'll do as well as I'll provide that link, and so people could go to it.
Perfect. Our audience loves nothing if not more data to sink their teeth into. While you're looking for that, I will pull up our next one here. Your popular guy here, Matt. Let's go to Nico. Nico has a more straightforward question. He wants to know, does Matt have a favorite overall option strategy, or maybe a few that he uses regularly in his own portfolios? Also, flip side, is there a clunker that he prefers to avoid? So Matt, you're sitting there on your own accounts, trading your own dime. What are your go-tos? Sounds like you're a bit of a covered call guy, so maybe in there. I know you're liking selling a little bit of wings right now, so maybe a little bit of that. But what are your go-tos right now? What do you typically tend to employ? And then flip side of that, what do you avoid like the plague, sir?
So here's a story. This morning, my wife texted me a Twitter post by Christopher Cole, his Artemis, and he went over his strategy where he likes to overlay certain strategies together. And my wife knew that I was working feverishly on this over this long weekend. So I like to have a strategy that employs different types of strategies, and they all work together. So let me just break that down. The first thing to do is to find a strategy that you really like that's going to provide you some good amounts of return. So let's just say, it's I'll say one of the ones my favorites right now is a poor man's covered call in SPX or SPY, where you're actually selling an in-the-money put, buying an out-of-the-money put. And so that's like selling an out-of-the-money call and buying an in-the-money call. I don't know. So take my word for it. So that's done. That strategy is done well. And by the way, that's also a diagonal. So you are buying longer dated and selling shorter dated. So that's a good strategy. I mean, that's just a basic kind of long and selling. That's almost like a covered call strategy right there. So now, obviously, that has problems if the market goes down. So now I want puts with that. So I have these puts that normally cost you money, but we have very, very long-term puts that I like. So 555 days, 10 deltas, way out there, and some 90 day 15 deltas, something's around those time frames. And Mark, I should also suggest this isn't investment advice. These are just tests and some things that I do for myself. If I were advising someone, and I am a registered investment advisor, I would want to know, about their risk tolerances and all that. So I'm just kind of putting things out there for people to do more studies on and ask their advisors about. So then I have the put. So now I've got a long put spread or a long call spread essentially, and then a few puts on top of that. And then when you back test that, you'll notice that that actually performs quite well. And the year it doesn't perform well, 2018. 2018 is a tough year. And so what you needed in 2018 was especially in December when the market corrected, but we really didn't get that big of a pop in implied volatility. So the puts that you had, those way out of the money puts, usually when the market goes down, they explode in implied volatility, and that's a good hedge. But if the market's kind of just melting down to those puts, you're not really going to get the bump that you need. And that December was not good for this strategy. So on top of the strategy, I put, what really worked well in 2018 was a put calendar. And again, it's a diagonal, but so a out of the money put calendar. So as the market kind of melts down to that strike, that's where you want it to go in a put calendar. Now I know I'm introducing a lot here, but that's the type of overall strategy that I like, Mark. One that's, that I could just go to bed and I don't care. Like if it goes down, I'm going to be fine. If it goes up, I'm going to be fine. And, I will also throw a short put spread on top of that if my decay gets too much. If the market looks like that, looks like it would be right for it. So I'll throw some things on it like a UVXY, like a long put potentially. I'll throw things on it. What else do I throw on? Like a VIX. We're going to talk about VIX a little bit later, but maybe a long put in VIX. So those are, I have some ancillary strategies, and then I have some strategies that are there all the time. So I don't know if I was clear enough on that, but those are the types of strategies that I like to do, Mark.
I like it. You mentioned calendars. So we got this one coming in from the live crew right now from Barrel A. Barrel A wants to know, would you rather set up a time spread in a contango or in a backwardation implied vol environment? Well, Barrel A, if you give us any more details, I'm assuming you want your straight up typical 1 month at the money, buying the 1 month out, selling the front month. I'm assuming that's what you're going for. If you have something else, let us know. Matt, obviously you're doing that in a nice backward IV environment. You're going to get a lot of juice for that front contract when you're selling it. The flip side, of course, is going to be whipping all over the place. So what are your thoughts here for Barrel A? You're doing your calendars, your time spreads. What do you like, contango or a little bit of juicy backwards IV, sir?
First, so just so everyone understands what Barrel A is asking. So a time spread is when you're long the longer term and short the front. And in backwardation, the front is higher. In contango, the front is a lower implied volatility. So, intuition might say you'd rather sell it in a backwardation environment because you're getting, like you say, a lot more premium in that front month. However, there's also premium. What usually happens is both of them go up. Backwardation doesn't mean that the back didn't go up as well. So that's not always the case, Mark, where you want to do that type of a time spread in contango or backwardation. As a matter of fact, I would test it. I didn't see this question come in, so it must have been from a recent question, or else I would have thrown it in the back tester. But I would say contango probably would test better, just because as you say, what's going on in the market might drive it away from the strike where you want it to go. And kind of a rule of thumb that I tend to think about is the market doesn't get the volatility low enough, and they don't get the volatility high enough. And what that means is when there's not that much volatility, they don't get it low enough. They won't take it down past a certain amount. That's usually a contango type place. And then when it gets really high, they don't get it high enough. So I think both of those play into selling those in a contango. And doing a time spread in a contango would probably be, without testing it, the guess I would make, Mark.
Yeah, you're right, because your intuition would say backwardation. You're getting all that juice, right? But you're whipping all over the place, too. And contango is certainly probably more predictable, more reliable over time. Backwardation, kind of probably more of a bit of a crapshoot. Interesting. There you go. See, listeners, you're inspiring interesting back tests as we speak. Since we're talking the live, let's go back out to the live. My boy Luigi's got another question out there. So yeah, if you guys listen in live and you're pro members, you get to jump to the front of the line of all this cool stuff. You get to bump everybody else who sent in other questions down the list a little bit. Let's see here. My boy Luigi wants to know, he's going back to skew again, Matt. He says, while looking at the skew, if the implied vol is higher, should you build a position around that side? So he's talking about when the side is bid. So it sounds like in a traditional equity, he'd be talking about building positions around the put side, Matt. What do you have to say to that? Building your position around the side of the skew where the implied vol is higher.
I mean, logically, that is the case, right? Because you want to profit from that skew coming back down. And so you would do like if the skew, the put skew or the low strike skew is much higher, you might do a put spread, and you might do a call spread if the other side's higher. So yeah, I would look at the side where we thought the implied volatility is higher, and have your strikes around there, Mark.
Go where the juice is, Mr. Luigi, as opposed to where the juice has already been squeezed out. All right. Next up, got another more kind of 10,000 foot questions. Comes from Al's with 2 A's. They want to know, what's the most back-tested strat at ORAT? So, Mr. Matt, you guys are the keeper of the back tester machine. People are banging away at it all the time. What is the hot thing? What are folks testing away and banging away at right now over there on the magical back test machine?
I'm very happy to answer this question because we don't look. So as opposed to every other app out there, it seems like, that tracks your every move and knows everything about everyone, we don't look at ORATs. We don't monitor that. We want complete anonymity with our backtest people. We're not looking at the good ones that people do. We don't look at any of that. So when you're backtesting at ORATs, you can feel confident that we're not looking at it. We've had only one client that wouldn't backtest with us because they were so worried about their great strategy. They didn't want us looking at it. And I said, listen, I've been in business since 2001. I have to keep everything under wraps. I've never had a problem with it. And they still wouldn't do it. It's a very famous fund, by the way. But we don't look. I'd like to know. I know the ones that I'm talking about are the ones that I get asked the most about, and the ones that I work on the most. But we don't look, Mark.
Interesting. The anonymity. So you can't even do like some sort of anonymized, just kind of aggregate data, like, hey, X% are doing covered calls, and kind of group them into buckets. Nothing even like that.
No, we don't do that. Again, we want to keep it as anonymous as possible.
I gotcha. People out there on the pro side, they appreciate their anonymity, even though it would be fun to crunch that data a little bit there. All right. Next up, another one back from the live chat. Big Mon. He wants to know, has Matt ever back tested the iron fly. Well, you didn't give us much criteria to go on there, Bigamon. Do you have a particular underlying or a particular way you like to structure your iron fly, a certain percent out of the money with the wings, anything like that? But that said, Matt, general iron flies, is this a strategy you like, and have you ever run any back tests on these?
Well, I'm going to guess it's a Kurt Duplessis over at Option Alpha type iron fly, our friend.
Does he like iron flies too?
And he does a lot of these. And so it's usually ETFs. We have, they test okay. But with the iron fly, it's a, like I said, it tests, decently. But you're the reason that you're doing an iron fly in a lot of cases is, you need to protect your wings, and it just depends on how how well you could buy those wings. Is that actually derives a lot of the strategy, and often in the underlyings that people are using, the wings are actually pretty wide and difficult to buy. So a lot of that has to comes down to execution and knowing when to buy the wings. It's not necessarily the IV, but that's what most people key on. But it's getting a good fill, getting a good wing, because that really eats in. Like I said before, the premium that you're getting is not, even though you're getting a lot of premium, it's that the probability of keeping that premium is what you're really concerned about. And you can't just give away a small put just because you think that it's not taking that much away from the entire strategy, because that is often the profit. Your profit amount is that wing, so you have to be really careful about the wing. So, what we do in our testing is we will set pretty tight constraints on, and you could set how wide you want each leg and the overall, and so that's what comes. And that's what's very important in these are the wings. So often when I trade, I'll try to buy the wing first. I know I could get some premium and they at the money, but getting a wing when it's might be 15 cents at 40 cents, you don't want to pay the mid market there. You're giving up an awful lot of money. So hopefully that makes sense, Mark.
Go for the wings first when slinging an iron fly. Interesting. I used to have a cohort, a compatriot on our Volatility Views program who, because I've always been a fan of iron flies, and the iron condors always got so much more love, and it always mystified me. And he used to joke that an iron condor was the iron butterfly for cowards, Matt. What do you have to say about that? I like that saying.
Well, it's the same thing. The iron fly, again, most people don't pay enough attention to how much they're paying for those wings. And I in my trading, I test each grouping separately, and often I think it's better to do two diagonals rather than a. Why do you want to have a fixed iron fly? I mean, it's easier to understand, but a lot of times that isn't the best strategy to put on. So, if you're really looking at it, you would consider at least a diagonal, selling a diagonal out there, and also you would look at having different deltas that you're using for the call side and the put side for the diagonal, and different deltas, different days to expiration, all that stuff. So I don't like how constraining both iron flies and iron condors are. I like to look at it on its face, and we do a complete forecast of every single option and each surface, and we could put that into our scanner. And so I could see which options I think are under and overvalued. So I have a lot more of a pick between those, and I think that's the important way to look at it, Mark.
Interesting. Not a fan of either. You prefer the diagonals. We can get into that more, but we got more people hitting us up. Next up, we've got Matt. Matt Thomas wants to know. Another Matt to Matt here. He says, I've got some nice gains in SPY, Amazon, and Tesla right now. Well, you're probably not alone out there, Matt. A lot of people have had decent runs in the broad market and in some of these names you mentioned over the past year or so. He wants to know the perennial question, Matt. What is the best way to protect them? He's got a two-parter. Over the summer, And then for the rest of the year, I have to imagine a lot of people are coming to you at ORATS right now, Matt, with some variation on this exact same question. I'm sitting on X gains in this underlying. What the heck should I do? So he gives us some specifics. He says SPY. So we're talking broad market as well as some more kind of high flying tech names. What are your thoughts on the effective ways to hedge these in the near term and longer term, sir?
Again, this is an investment advice. There's some tax reasons and such that you'll have to look at. You can't look like you're selling the stock using options. But I have to tell a story. It happened around 1999, 2000, around the dot-com boom. And a guy came to me and said, hey, I have all this eToys stock. And the eToys is trading about 80, 85, I believe. And so I go, well, you're going to want to put a collar on and, sell a call, and that more than paid for the put. And, if that stock wasn't trading $4 three weeks later, and he just, it just totally protected him. So,
did he give you a big hug and a kiss, sir, after that?
Actually, no. The most thankless thing ever is a investment advisor.
You're right.
They'll get you if you miss it, they'll give you a hard time. But there's not a lot of thanks. So you just you have to be just confident in what you're doing. Let's put it that way. Anyway, so a collar's the easiest, and again, they don't need to match up. Meaning you don't have to sell the call and buy the put in the same month. So I would look at look at your outlook, look at what your gains are, and do some type of a collar. People do put spread collars because puts are expensive sometimes, but now with the calls, especially in the ones that he's talking about. SPY, you might consider a put spreads collar, but Amazon and Tesla, they have pretty good skews to them. So you could sell some calls at some pretty good prices there, and still out of the money enough so you're not really going to give away too much, and you could get a put. And I wouldn't get too fancy like with a put back spread or something like that. But I would just puts are your friend. Get some puts, different expirations. Multiple years down to 90 days. I wouldn't go less than 90 days. So hopefully that helps.
Collars, a big fan of collars. And I'm sure you've probably seen this data as well, Matt. One of the most far-reaching studies I've ever seen on the collar was back a few years back now. I'd like to see an update to it because it's been probably 4 or 5 years since they've really run the research. But the folks over at OIC did a great collar study. They started it with collaring the Qs, and then they expanded it to other equities, and they expanded it to other asset classes. You can look at gold or ags or you name it. They really explored how to use collars on a number of different underlyings, and then also they played with it. Like you mentioned, Matt, they played with the collar. That's one of the cool things about the collar. That's what drives me crazy. And people come in, they're always, I want this zero cost, keep everything in the same month. And that's usually the least effective way to do a collar. You push that put out a little bit, and I think the OIC data centered around somewhere around that 6-month time frame was a bit of the sweet spot, and then you push that call side up. I think when they were running this data, the weeklies still weren't as big of a player, so they ended, I think, around the monthlies, but I'd be interested to see an update of this with the weeklies as well. I'd imagine that would probably change the game a little bit, but if you play with those calls and those puts a little bit, there's a lot you can do with a collar. And at the end of the day, if it works out well, it probably won't cost you that much. And a lot of great data on how they outperform. Matt, have you seen this data from the OIC folks? It's a little bit dated now, but it's still, to my knowledge, the most exhaustive analysis of collars I've ever seen.
Yeah, I wish I could remember that guy. I like this guy who did it. If someone in Mixler knows, his name escapes me right now, but I was there for the presentation and and I think I have the paper. And they did a nice job on it. Again, what I like to suggest is test the puts separately from the calls. Like, for example, I think you want to sell a shorter term, more out of the money call, buy very far out of the money, longer term put, and you could even buy more puts because they're less expensive. So that's those are that's the way I like to do it, Mark. Not testing it as a caller. You could then bring it back in our back tester and combine it and see how it looks. But that's how I like to at least start out. Look for the best call on its own, and then look for the best put on its own, and do it that way.
Yeah, I think it's interesting. I know Phil Gocke commissioned the research. I forgot the name of the researchers who actually conducted it over there. It could be Black and Cesato. They did a lot of stuff for OIC back in the day. But I'll have to go look. I know they had it.
I think it was Black. Yeah.
Yeah. Okay. Probably was them. That Black and Cesato did a lot of their stuff. And we've linked to this study in the past. Maybe we'll link to it again. It's still the most comprehensive look I've seen at collars across a broad array of asset classes. So if you're in the same category as I forgot the name of the listener here. What was it? Matt, who's sitting on some gains. You're looking at ways to hedge them. You don't have to go crazy. Keep it simple. Stupid does work. A collar, it can be as complex as you make it, but you probably want to play with it a little bit to make it a little bit more effective. And there's a lot of great data there on how to do it. Or hit up Matt for a more specific analysis with his magical backtest machine. All right, Matt, I knew we'd probably before we get to that, we're kind of getting memey now. Here comes some of the meme related questions. This is a number 2 here from Nico. Yeah, because he just asked a question a little while ago. Nico coming in again. He wants to know, does ORATS offer any sort of small delta call scanner so we can track down your, quote, Robinhood effect for ourselves? Matt, this is kind of something you've been chronicling for a while. You mentioned at the top of the show what you term the Robinhood effect, the bid of all these, retail Robinhood, whatever you want to call them, accounts piling into the upside typically in these names. Nico wants to know, are you doing any sort of scanning for people to try to find this stuff?
Yeah, so I'm going to combine maybe a couple of the questions. As I mentioned on the advisor's option, I saw this back test that someone else did, and it was on these very small calls. And I noticed that they used almost a VIX calculation to determine fair value. We have a forecast of volatility that looks at historical volatility, earnings, skew, all this stuff, right? And so we forecast the entire volatility surface for every option. And I noticed that we were in agreement, so I thought that was neat. He used a pretty exhaustive method for calculating what he thought the upcoming volatility or fair vol would be for a lot of these stocks. And what he was finding is these, like, some of them have like zero theoretical value, and are bid in the market. And we do something like that. So we start building with a forecast, but then we use the skew in the market in order to skew it up. I don't know if that makes any sense, because if you're looking at just volatility, you're never going to get the calls as high as you need them. So we have methods to put our forecasts and then bid them up in the very far out of the money. So, I'm talking 0 delta, 1 delta, something like that. So yes, the answer is yes, we have scanners. I use them. And what the way I do it is, I do I think it's like 5 to 40 days, and like between, 1/2 of 1 delta. So 0.005 and 1 delta. So we're really far out of the money. And then I could sort on our forecast. And so I'm often finding 99%, 95% of value. So it might be worth a penny, and it's trading $1, something out there. So that's how I will find those. So I would use that type of a scan in order, and then I could paste in, a couple hundred of the stocks that I could go in our data API and find stocks that aren't as crazy as maybe the meme stocks or whatever. And so now, like Adobe is coming out, FedEx, Boeing is, there are some really high wings in those types of stocks that I'm comfortable selling a couple of those. And then, as you collect, and then, I put in a bid immediately at 50% profit. And then, so I'm just trying to get, as we say, pick up pennies in front of a steamroller. But I think the steamroller is pretty far away, and I could see it pretty well, I hope. So that's, yes, we have a scanner that I think works quite well. And you could go ahead and set it up. The way we set it up is we set up a back test, and you could set up, that delta range, and you could set up, stocks that you could filter out and have a certain amount of volatilities and such. So I'm able to define the stocks, define the options, and then sort on our forecast value. And I've been finding some pretty good options, Mark.
Well, speaking along those lines of trading the meme names, we got some related questions here, Matt. We'll lump them together. You kind of touched on a little bit of this, but first one comes from MMT. He says, what's the best way to trade meme stocks using options? I know buying calls can work out, but that's usually very expensive. My approach has been approximately 5% to 10% to 15 to 20% out of the money butterfly. So I'm assuming he means buying the leg 5% out, selling the leg 10% out, and then buying the second leg 15 to 20% out of the money, somewhere in that range. So, Matt, what are your thoughts on using call flies or perhaps put flies in the meme names? And then a related question here from Victoria. She wants to know about everybody's favorite these days, AMC. AMC is currently trading at approximately 300% volatility for at-the-money options in June. How would you recommend trading that using options, or should I just steer clear? So, Matt, I knew we would get memey eventually. Here we go, sir. What are your thoughts here on everyone's favorites these days, AMC, game, and related names, and how, if possible, I know you like selling the crazy wings, but how, if possible, do you like to approach these, sir?
Yeah, so here's how I would approach it. First of all, the butterflies, usually not the best way to go on these, because the butterfly, is I think more for something that where you could leg in or get a butterfly very cheaply and then have the stock kind of drift towards that central strike, and then you do well. These meme stocks are such high volatility that it's hard to find good butterflies. So the butterflies aren't really the way that I like to look at it. The way I like to trade, as you know, Mark, is to find some there's some pretty crazy pricing out there. Now you have to do it very small, but there are ways to do it. For example, right now there's with AMC is trading 31, the 60.73 vertical is trading 86 cents. So you could sell
60.73. I love it.
Yeah. So here's what's going to happen, right? So you sell that for 86 cents. It has to double. By the time it's doubling, the 73 calls are going up too, so you could get out. So that seems like that's what's coming up on our ORAT scanner. It's got a 15% edge in our forecasts. We also do edge in our distribution, 6% edge. So those are the types of trades that I would look at. So there's edge in the call. Let's see, the best put spread coming up right now is a 26-21. I wouldn't like that, but it's 274. So you're selling a $5 put spread that's $5 out of the money for 274. So you're getting a fair amount of money for it. So that's in June or early. That's a month away. So I'm sorry, July. That's July in a month. So those are the types that are coming up on the scan. There's not a huge amount of risk in that one. I mean, your risk is only, what is it, $2 and something. So to make 274. So that's what I would look at, Mark.
Yeah, you're right. These are challenging, and you're right. Butterflies are not ideal. Every once in a while, I'll try a flyer out there, Matt, on some of these, like put on a crazy bid for like a nickel and a dime and some of these crazy names. I got filled on one this morning in AMC for a dime, and it was a pretty decent fly. But you're right; these things are whipping around so much that the chances of these things coming in right at your max strike are pretty much like throwing a dart, which is why I don't spend a ton on these. But I do like that notion of the far, far upside vertical. And you're right, going back to that question we had earlier about delta neutral, if it does start to come to pass or those strikes are suddenly coming into contention, you have a lot of room there between where it's trading now, 30 and what'd you say, the 60 strike, to pick up a little stock if you wanted to actually hedge that if you are worried about the worst coming to pass. So if it did break into the highs, but I think we got a ways to go before there. But interesting stuff as well. Speaking of names people like to trade, Matt, and have questions about these days outside of all things memey, people like volatility as well, in particular VIX. This next one comes from J-Tau here, and we're kind of coming up against it. So let's see. This may be our last one here. We'll see. J-Tau says, I've been looking at VIX calls for a while to spec on a market downturn. Do you have an optimal approach when trading VIX calls? Simply long out of the money calls, but he puts in parentheses, that gets pricey pretty quickly. Should I look at call verticals or butterflies? But he puts in parentheses, that limits your ability to capture upside. Or perhaps something different, like ratio 1/2 call spreads, where you're short 1 and long 2. Matt, this is kind of like the perennial question in VIX land as well. It's like, how do you keep your table stakes? How do you keep your seat at the table until you can capture that big explosive upside like we saw last March that we know VIX is capable of doing, but it gets expensive over time to maintain that. So what is your go-to, if you have one, Matt, for folks who are looking at speccing at a little bit of upside right now in VIX?
Yeah, and again, this is not investment advice. But yeah, I have some absolute favorites. And, if you want to hit me up, matt@orats.com. I love this strategy. It's a call back spread. So short 1, long 2. You do it for a pretty good credit, at least 0.5%. And so you have units, you're getting paid, and it performs pretty well. So so I like that one. And I like, longer term, way out of the money, VIX calls, just to have those on. And, you'll get paid maybe 3 times over the next 10 years. And unfortunately, and you have to do it small, but you should just have some, again, try to get filled as well as you can, but just have some, little, I always have puts on, I always have little VIX calls on. I like this, that's not a real strategy, meaning, it's just something to keep in your back pocket. A real strategy is just it takes a little bit more work, this 1/2 call back spread, way far out of the money, but you can still get some decent premium out of it, and you still have units, what you always want to have in VIX is units. You'll get paid, a decent amount, in the big times, and you'll make some selling calls, call premium. So that's a strategy I really like, Mark.
Yeah, it's hard to argue against that one. That was the go-to for a long time in VIX land. It requires a certain, degrees of setups up there in the market to really be optimal, the selling 1 and buying 2. But you're right, that does get you the long units. It gets you to keep your seat at the table and allows you to capture those moments like, let's say, March, without expending an exorbitant amount of money, without going out and gobbling up a bunch of calls. That definitely longer term is one of the ones I like to look at as well. Unfortunately, Mr. Matt, that music means we've come to the end of our inaugural Options Pro Q&A session. I want to thank all of you out there who joined us for this week. It was really fun. You guys hit us up left, right, and center. Remember, going forward, these are going to be for our pro members. We're going to have a lot of great guests rotating in. So if you enjoyed this, you want to get another crack at the old apple here and join us on the program with your questions about a broad variety of things. Maybe you have a guest you want to feature on the show so you can pick their brain. Join up, hit us up, let us know. We're pretty accommodating with that kind of stuff, as you can see from the wide range of questions we took in today. But Mr. Matt, I want to thank you for patiently and ably taking on all comers here. You set the tone for all others to follow now in our Q&A sessions. But if folks are intrigued, they want to kick the tires for themselves on all the various things you talked about today, sir, the back tester, the earnings data, all this other cool stuff you have cooking, where should they go? What should they do, sir?
Well, Mark, first I'd like to say that you are doing a great job. These questions are amazing. These your listeners are off the charts. So I mean, you should take a bow, and when you get back up, you could go on over to orats.com. Hit me up at matt@orats. We have consulting services. If you have if you want to see some of these tests, like I said, we're registered, so we could talk turkey on a lot of the stuff. We have some awesome optimizers and back testing and simulators and machine learning. And so it's the reason I started ORATS was to get what hedge funds and only the largest funds and pension funds could could have to regular folks. So, come on over to ORATS. There's a lot of great stuff there. We've been working on it since, like I said, 2001. So there's amazing tools, a lot of data, and we could get you set up in some strategies. At least back testing can save you a lot of money going down the wrong path, and there's also some really nice strategies out there, Mark. So appreciate being the first one on the show. If this is any indication, it's going to be a very successful show. So thanks for having me on.
Well, thanks for joining us, Matt. And you did set a high bar for all of our future guests to follow. So we'll look forward to seeing if they're up to the challenge. And I agree, our audience is clearly up to the challenge. Great questions, everyone out there, left, right, and center, all sorts of fun questions. We didn't even get to all of them here. So keep hitting at us, keep sending those questions. And if you like what you heard, again, head on over to theoptionsinsider.com/shop. That'll teach you and show you all the information of all the different things we have cooking over there, as well as what you can expect. This, a lot more when you join us for these fun sessions. Again, more coming. These are going to be probably every Tuesday, and then oddities on every Friday to start, and then a lot more to come down the road. Of course, there's more coming tomorrow. You got Options Bootcamp, Options Playbook Radio hitting the network as usual tomorrow. And then Thursday, back again for episode 2 of the Option Block. That was off for Monday, so that's our first dose of that for this week, as well as TWIFO Friday Volatility Views. It all kicks off again next week with another fun array of programming, and the next Tuesday with another fun pro Q&A session.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.